Hi everyone, my name is Ved Ghosh, and today I will be talking about my portfolio's performance in the market from the month September to December. I will be going through the portfolio's performance and investment goals, investment strategy, rationale, charts and diagrams of our performance, conclusion and findings, and finally the credits. We will begin with the portfolio performance and investment goals. My company had a return of 143.80% over the 4 months. The S&P 500 only had a return of 11.75%, which would mean that I beat the S&P 500 by 132.05% over the 4 months. I began my journey by setting a few goals for myself. The first goal was to develop an investment strategy that can consistently be used and built on in the future. My second goal was to understand trends in the market during a time of recession and how to protect capital. And my final goal would be to predict which market sectors would be more stable during the pandemic. Next, we will go on to my investment strategy. I would divide my portfolio into the two categories, short-term trades and long-term investments. These two categories are the basis for my strategy for which companies I chose to invest in during the 4 months. For my short-term trades, I would base all my trades on a 4-step process that would determine the sustainability of a company with a surge in stock price. The acronym that I use for this 4-step strategy is FAST, or FAST for short. The first step, F, was to find and discover companies with large price changes. I would use sites such as TradingView and Yahoo Finance to find these companies and use the next steps and analyze if these companies' growths were sustainable. The second step, A, is to analyze if the growth was sustainable. I would use the company news and the reason why the stock had such a high growth to understand why the company had grown so high and determine if its growth was sustainable or not. The third step, S, search recent company news and industry trends. This is tied with the second step. I wanted to have a little bit more context around the companies that I decided to take short positions in, so I would make sure that I would be securing a profit with as little risk attached. And the final step, T, take a short position at the company's perceived peak. For my long-term investments, I would base my investments on a 3-step process that would determine the profitability of specific industries during the pandemic. From there, I would select specific companies from those industries that I believed had the most room to grow. The acronym that I use for this process is AIM, or AIM for short. My first step, A, was to analyze the potential of certain industries with minimal attachment to the pandemic. My second step, I, was to identify established companies that fit these industries. And my third step, M, was to model a roadmap of the company's 4-month trajectory after doing a fundamental analysis on these companies. I will be going into further reasons to why I invested in each of these companies in the next section, rationale. For the diversification for my short-term trades, I divided the companies I invested in into inflated news and controversial companies. There were many companies that I took a short position in due to growth that I believed was unsustainable. As talked about earlier, there were many companies that had a large surge in stock price, but there was no news surrounding that company that fit the growth for that stock. Because of that, I would take a short position at its peak and try and secure profits from there. I also took positions in a few controversial companies that investors shied away from. This would usually be if a company was hit with a specific lawsuit or had fraud inside the company, and I would decide if I believed that the short-term trajectory was bullish or bearish based off there, and take short positions or invest in the company from there. A few examples of my short-term investments. On the left side, we have 2 inflated news companies that I invested in. The first one shown is Westwater Resources, a mining company, and the second one is 5 Prime Therapeutics. On the right side, we have 2 controversial companies that I invested in. The first one is NanoX Imaging, one I invested in, and the second one is Nikola, one I took a short position in. For the diversification of my long-term investments, I chose industries that I believed would be the most successful during the pandemic. I believe those to be online retail and electric vehicle companies. For online retail, my initial thought was not to invest in retail at all. It was seen as retail was one of the most hit sectors at the beginning of the pandemic, and it took a huge nosedive because people would not go out and shop. It was that simple. But after looking closely, retail companies that had a structured online business model or had transitioned into one did well due to stay-at-home orders during the pandemic. One companies that had a structured online business model, such as Amazon, were beginning to grow at that time, but companies that had transitioned into an online business model were also growing, such as Domino's, Best Buy, and Target. For electric vehicles, the EV industry seemed low risk because of favorable government policies and subsidiaries. An example is a California executive order mandating all cars to be electric by 2035. Yet, because of this, strong investor interest led to overbought situations. So I proceeded to take a short position in a few EV companies, believing that the news surrounding these companies had a bullish long-term trajectory, but a bearish 4-month trajectory. Over here, you can see a few of my long-term investments that I had made. On the top left, we have Best Buy, an online retail company with a bright future with the upcoming stimulus. Anytime Congress announced that they were in talks of a stimulus, Best Buy would have an increase in stock price, and I took that opportunity and invested in the company when I believed it was at its low point. On the bottom left, Apple was a tech company that after its stock split dived a lot, yet they had a bright future with their event coming up and the Christmas season. After the stock split, Apple's company stock price had went down by 20%. Yet there was so much positive around this company and so much future, and I believe that it was a worthwhile investment to make. On the top right, we have Spy Energy, which is an electric vehicle company that was overbought by investors. Spy was a company that had announced its introduction into the EV industry, and on one day, the company stock price increased by 4,500%. 4,500! And I believed that taking a short position at that peak and waiting until it went to a reasonable value would be the best choice. And so I took a short position in this company. On the bottom right, we have Target, an online retail company with success during the pandemic and just a brighter future to grow with the Christmas season coming up and Thanksgiving and talks of a stimulus. I decided to take an investment in it when I saw the chance. Here are some charts and diagrams of my portfolio performance. Here's a visual for my portfolio distribution for my major investments. On the left side, we have short-term trades, and they're divided into inflated news and controversial companies as discussed before, and we have a few companies that I invested in. On the right side, we have some long-term investments that I had made, and they are divided into the sectors electric vehicles, online retail, and a few other companies that I decided to invest in due to their trajectory. Here's a chart of my overall portfolio performance. As you can see, the largest gain was NanoX Imaging, a gain of 49%, and the only loss was a loss for Domino's Pizza, 7.3%. As you can see, there are many sectors where the trading is divided into, but primarily electric vehicles and online retail, and there's a mix of buying these companies and short selling these companies. As you can see, the individual stock performance of these companies. At the left, we have Apple, and on the right, we have Target. The black star shows a majority of the holdings bought. The white star shows a majority of the holdings sold. The D shows the dividends received, and the E shows earnings report. On the left, we have Apple, and over here we see in around late September, a majority of the holdings were bought and were not sold throughout the whole 4 months. For Target, we see that a majority of the holdings were bought in around middle of October, and they were sold in the middle of November. Over here, we have similar shown as what is on the last slide. On the left, we have Best Buy. On the right, we have NanoX Imaging, a short-term company that a short-term company. For Best Buy, a majority of the holdings were bought in late September, and they were not sold throughout the whole 4 months. For NanoX Imaging, a majority of the holdings were bought in very late September, and a majority of those holdings were sold in the first week of October. Here we have our conclusions and findings. Here are some of my findings from my portfolios. I believed that my most successful short-term trades were the ones in controversial companies. That is where I made the most revenue. My most successful long-term investments were my short positions in the EV industry. As I predicted correctly, the industry was overbought, and with that, the company stock prices would begin to lower in the 4 months. I was able to achieve and exceed the goals that I had set for myself and create an effective strategy that I want to build on in the future. I believe I still have much room for improvement as a trader. I believe I could have entered more markets with more confidence in the research that I had done. An example of this is Domino's. I'd been following Domino's for a while, and in the beginning of September, I contemplated investing in the company, but I did not have enough confidence in the research that I had done. Instead, I waited for a full month to invest in the company when it had gone up by 15%. And after that full month, the company had went down by 7%, and I had decided to cut my losses from there. If I had more confidence in my data, maybe I could have made a better decision. Another thing I want to try and do is lower risk on future short-term trades by shorting companies I have a little bit more familiarity with. Using sites such as TradingView and Yahoo Finance to find these companies is great, but I want to have a little bit more familiarity around the companies before I take a short position in them so I can lower my risk. My final improvement is to become more risk-averse as a trader. Overall, I was thrilled with the performance of my portfolio, but not overly satisfied. I created an effective investment strategy that can be tweaked in the future, and I also predicted which industries would be profitable during the pandemic. We were able to beat the S&P 500 by 132.05%, but I still believe I have room to improve. I could have made a greater effort to lessen risk through some of the investments I made. Learning to balance the risk I take is an essential tool I want to understand more in the future. Just as Melody Hobson, one of history's greatest investors and the current chairwoman of Starbucks, once said, "The biggest risk of all is not taking one." Here are the credits. Credits for the presentation was made by SlidesGo. Thank you. If you have any questions, please contact me at the information there. Thank you for listening.